Analysts are getting bold. Tesla's price targets are rising fast. The bulls now see $500 to $600 per share, but our guest today says that's still way too low. He's run the numbers using a sum of the parts valuation and discounted cash flow model, and his fair value lands between $660 and $1,200. And if you include Optimus, that number could soar past $2,000 today. So what's Tesla stock really worth? Let's find out. We got Cern Basher. He's a chartered financial analyst running his own investment advisory firm called BrilliantAdvice, providing wealth management services. Welcome, sir.
Hi, Herbert. It's good to be here. This is one of our favorite topics.
It is. We visited 3 months ago, and I encourage people to go check that out because even though it was 3 months ago, it's still very, very pertinent today. You are one of the few analysts that actually do the work, spreadsheets, and you break down the Tesla's business into multiple business units, step one, instead of just adding some sort of multiple to this business because it's not just a car company. And then you create forecasts for each one of them, line by line, detailed, all sorts of things to make sure that you're not being too, out of whack. And you bring it out to multiple years, and then you discount it back to what is the current price target today. So the reason I wanted to bring this up today is because we actually have seen institutional analysts raise their price targets. And of course, they're just chasing the stock, right? The stock is now at $450. They're trying to chase it. But I'm going to show Bank of America, who actually has a sum of the parts analysis, and I wanted you to break that down, and also Morgan Stanley, what they're saying. So let's get started. So just to show folks, this is the deck that you did 3 months ago, and you explained to folks the sum of the parts, and then we will jump to the key parts where you explain what you think the Tesla stock price should be worth today, depending on which businesses you want to include. Yeah.
That sounds good. Yeah, I think it's a good exercise to go through to understand the value drivers for Tesla and where the future value will come from.
So explain what is sum of the parts, first of all, versus what kinds of analysis other analysts do.
Well, you could look at a company in totality, right? You could say, okay, here are the current earnings of Tesla, and you could project a growth rate. You could say that Tesla's going to grow its earnings by, picking a number at random here, 20% per year. And then you can run a valuation model just based on that. The problem with that is you are just kind of assuming a steady state that the business is just going to achieve some kind of average growth rate. You're not really counting fundamental changes in the nature of the business. We've talked about so many times how Tesla's evolving from a car company that makes a low margin selling a product once, and in the case of consumers, maybe once every 5 years or 7 years, to a recurring high margin revenue model. Right. And that's a fundamental change in the business model of the company. So the best way, in my opinion, to deal with that is to break down the company into its individual pieces and make models for each segment. Autos, energy, robotaxi, Optimus, semi and Robo-Trucking, potentially at some point distributed inference. The list goes on in terms of the potential businesses. Develop a model for each one, project it out, discount it to the present, add them all together, and that's the sum of the parts.
Yeah. You're forecasting future cash flows if the business succeeds. And then I know that you put a variance scale on it. People can decide themselves. It's not going to be 90% market share. It'll only be 10%. And that's fine. Go ahead and do that. But at least do it. Because, right. And then you can also say zero. I think that this business is gone in the future. That's fair too. But at least look at it. So by looking at this table, you've got what year would this be where Optimus takes up like such a huge chunk?
I think this is 2035, I think is the date that this is cut. So 10 years from now, essentially. Optimus essentially is going to become, 80, 85% of the value of the company. And it's interesting, Elon has recently reiterated the same statement.
He did.
This is a conclusion I came to, a few years ago. And we'll show why in terms of why Optimus is so important to the company. Robotaxi is very significant, perhaps more significant in the near term in terms of Tesla's near-term growth. Optimus is a bit of a 3-5 year project from here. And then Robo-Trucking, let's not forget that. That's an opportunity with semi, energy storage, and autos, maybe about the same size in terms of its value. And then AutoBidder, which is the AI part of the energy business. What is not included here, and it probably should be, is FSD. You could say, I guess it's built into the auto model, but I didn't explicitly do that. If there are FSD licenses and some other automakers license FSD, that could also be a significant source of revenue and profits for the company.
Yeah. I think FSD will disappear. FSD is important for the next several years, but I think it's either going to be in autos or Robotaxi. Because if I buy a car and then I want to, make money out of it, it becomes a Robotaxi. And then that's, it'll just offset my expense for the FSD with my income from the Robotaxi. So it'll just be like, it's not going to be this net new revenue stream for Tesla. I think it's just going to be Robotaxi revenue. Okay. That's okay. So can you explain a little bit about how so many of the analysts today, they're saying the words Optimus, they're saying the words Robotaxi, but they still won't actually add cash flow, future cash flows in it because they still don't believe it's an actual business yet, versus you have gone ahead and said, nope, this is going to be a business. Now I'm going to put a variance to it, sensitivity analysis, but at least I do believe it is a business now. How do you make that decision?
Yeah, I think it's been a tough one for analysts because that business doesn't exist today. And I think analysts of public companies are really hesitant to stick their neck out and make projections about something that doesn't yet exist in the world. Optimus, to be fair, is in development. There is no sense yet as to what the demand is, what the supply is going to be. We don't really know what the unit economics looks like for Optimus. So we're making some projections. We're kind of sticking our neck out and thinking about this. Now, we're not alone in doing this. There's many of us that have done this work for Optimus, and it's interesting. We all sort of come around to pretty similar spots once you really think about it. And by the way, the same process for Robotaxi. There are many of us that have built models for Robotaxi, and I think largely we've all ended up in a very similar spot. So for me, the sort of the crowdsourcing of that, and along the way, Elon, I think, has given us lots of input and lots of ideas, and we're also sourcing information from other humanoid robot companies and what they're seeing and what they're doing. And I think we have a pretty reasonable model. The question for me is less about the model and more about the time frame, right? And that's the great debate in valuation is time frame. So this is kind of where you get to the issue, because a lot of analysts say, okay, since we don't know the time frame, it doesn't make sense to do a discounted cash flow model because we don't know what the cash flows are going to be 7, 10, 12 years from now. So they shortcut all that and just look at the next year or two, which by the way, have enough uncertainties of their own, right? Like what's Tesla's auto production going to be in 2027? What's Tesla's energy deployments going to be? How many robotaxis will there be in 2027? Like these are massive unknowns at this point, much less looking out into 2030 and 2035. But what I'm saying is it's still a good exercise. It still yields, I think, an interesting result in the sense of if you get an understanding of what the present value of the company might be given assumptions that you're comfortable with, then you can sort of triangulate between what the market price is today with what you think the company could be capable of in 5 and 10 years from now. And then you can make that judgment about, is this a good deal today? How much upside is there in this company relative to where I think it could be in 5 or 10 years? A lot of people don't want to do that. A lot of people just concern themselves with the trading activity of the stock today. Next week, they look at the charts, they look at how the stock's behaving. They don't touch it when it's not behaving well. They pile in when it is behaving well. And so that creates some of the extra volatility, I think, that we see in the stock, right? But for me, I want to position myself and my clients for the longer term. And I try to find companies like Tesla that I think have an outstanding future, given some very conservative assumptions.
Yeah.
So that's the overall approach.
That's fantastic. Yeah. So what I'm looking forward to doing today is, what is the fair value of a company's stock price today? And what you need to do is break down all the businesses. So I'm very curious how you would value auto business today, based on just auto business. What should the stock price? If that's all Tesla did was the auto business,
right?
What is the energy plus auto business? What is energy plus auto business plus Robotaxi? What happens when you add Optimus? All these things, and what's interesting, of course, is you've said this so many times, is retail investors like us, we are willing to stick our neck out and say, Robotaxi is a real business. I see FSD improving. I see the investment the company's making. I can see that it will become a business one day. And then in June, it truly happened. In June 22nd, it actually was. You and I were there. We got in one of the very first rides of Cybercat, the Tesla Model Y, which was a Robotaxi by Tesla. All of a sudden, that business is real. And all of a sudden, it's starting to make money. And so, but analysts would not even talk about it. They wouldn't even say it's impossible. They wouldn't even model it out. Now, you have already been modeling out Robotaxi, knowing that at some point it will become real. And then now everybody's modeling it up. Okay, so That's what we're going to do today. We're going to go through each of these businesses and find out what your present value is and compare it to how the analysts are. And so here's interestingly,
And just before we go there, Herbert, just let me mention this, that if you think about the disconnect between individual investors, people refer to them as retail investors, and Wall Street, institutional or professional investors, most professional investors are judged on kind of on an annual basis. If they outperform the market this year, there's going to be a nice big bonus for them, right? Retail investors don't have that kind of structure. It's not like your spouse is looking at you saying, Herbert, how did you perform this year? You know, you're going to get a bonus if you outperform the S&P 500. That conversation doesn't happen, I think, in most households. Maybe yours is the exception. Right.
It
Most
does
people are
happen.
looking out and saying, I want to retire in 2030 or I want to retire in 2035. Like that's usually where people are more focused on is that, longer time period. So there's just a natural disconnect between what Wall Street is doing and what they're focused on and what most individual investors are focused on. And I think it's just important to recognize that. Right. It's not that Wall Street's doing anything bad per se. It's just a different time frame, different incentives than what retail investors have.
Yeah, it's important to say that because now you explain the motivations and then we're going to see how they cover themselves. So just wanted to update everybody. This is what happened during this week. In just a matter of a week, these 13, I think, analysts raised their price targets for Tesla and they raised it significantly. So here's Wedbush, now at $600, Baird at $548, TD Cowen, 500, 500, 500. And so the vast majority, I think 9 of the 13 or 10 of the 13 are all over $500. And there's still some like Truist and Benchmark and Freedom that are $406. But they raised their prices from very low numbers of 280. Today, the stock price is at 450. So you got Truist at 406, thinking that the fair value of the company next year is going to be $406. Okay. And Morgan Stanley, Adam Jonas, he's one of the bulls for Tesla, and he's got deep research. I'm just going to point to the bottom here. It says, we reiterate our overweight rating on Tesla and note our bull case remains $800. So I just want to say that because today on X, there was a lot of people posting Morgan Stanley raised their price target to $800 and they're higher than Dan Ive 600. No, that's just the bull case. So my understanding is this is their bull case. They've always had a bull case at 600, 800. I think their price target is at 470. So I just wanted to mention that. But, there are bull cases. You should have a bull case. Yeah. And Morgan Stanley thinks that a bull case, the price target by next year is 800. So just just putting everything in kind of context, right?
Yeah, and there is something interesting here too that we are glossing over, which I think is important, and it's not one that I factored too much, but he talks about the cooperation between XAI and Tesla. And even if Tesla never invests in XAI, right? Let's say that doesn't happen. The more successful XAI is, the better the model that they build, that benefits Tesla because that model is going to be essentially the voice of the vehicle. The brains, right? Not the brains for the driving part, but just the brains that you get to interface with. And it sounds like, too, in the conference call, when Elon's talking about, we will be able to ask the car what it's thinking.
Yeah.
Right? And that's going to be incredible. So that's another thing I think that most of us are not really thinking too deeply about is that even if Tesla doesn't invest in XAI, the success of that company is actually very important to Tesla. And we will benefit no matter what, right? So again, that's not really something that's in my models.
I know. There's a lot of things like that is not included in the model.
Yeah.
Because just too many of them, and it's also a little abstract. But okay, so I want to go through your numbers and actually your deck and all the spreadsheets you've created to show what you think is the present value of the stock. I kind of shared some of the numbers already during my intro. But before I do that, I want to share what Bank of America does. This is interesting because this is the Bank of America. They're not like Morgan Stanley or anything. But anyways, so first of all, they actually called Tesla a leader in physical AI, but the valuation stretched. That's fair. So their price target now is 471, which is what basically where we're at now, 450 to 471. Okay, so that's fairly safe. But then they come up with, how did they get that number? And you can almost tell that it's all just a guessing game on their part, as opposed to like what you do. It's truly spreadsheets all over the place. So they are saying that they're using a sum of the parts valuation. So that's great. finally, we have a few of these. I know that Dan Ives says he uses it. We know Morgan Stanley does it. And now we kind of know that Bank of America does it too. Because everyone else, they basically just say, oh, here's a company called Tesla, and I'm going to put a multiple of it. It's a 200 times multiple. That's crazy. That's too expensive. I'm going to put a 100 multiple, 50 multiple, and that's how we get the proper stock price. That's how they do it. Because they think of it as just one company, and they go, oh, it's like compared to the autos, it's, it's more expensive than the top 10 auto companies together combined. And then they question why. Right. Okay, so some of the parts valuation, but this is very interesting. They are saying that 45% of that 471, 45% of it is Robotaxi. 19% to Optimus. How could you give 19% to Optimus, which is great, by the way, great, when the business doesn't exist yet? Because it's just another, they're bucking the trend of what analysts are doing here. I love the fact that they gave 17% to FSD. That's something we're seeing many analysts now say, because they recognize FSD as an actual line item. It actually delivers real revenue to Tesla. And now they're realizing how good FSD 14 is. They're realizing that it's not just going to be single digits of adoption. It's going to be like over 50 plus. And they're calculating future actual earnings, future actual cash flows. And they're saying it actually is, a business unit. That's great. Because again, we didn't have that before. Then you got 12% core auto. So just 12% of 471. So that's weird. They would only give what, $47 worth, $50 worth of the stock price is the car, and 6% to energy and storage. Anyways, wanted to walk you through that. What do you think?
It's encouraging and perplexing at the same time. Right. So again, think about these price targets, right? Typically they're sort of 1 year out numbers. So a year from now, stock trading at 470. Okay, well, that's pretty much flat, right? I'm assuming this is a year out. I don't know otherwise, but I'm assuming it would be 1 year from now. So they're expecting that Tesla stock is flat for the next year. So from that perspective, then they feel the valuation stretched because there's no return in the next 12 months, right? So that's where I think that comment comes from. But more important than that, the sum of the parts valuation, again, I think it's the right approach, right? And unfortunately, we don't have the details here of what goes into their assumptions. Kudos for them for taking this approach. And I think they're getting a lot of this right in terms of directionally, right? The two main drivers of the company are Robotaxi and Optimus. Now, I think ultimately Optimus is probably 80% of the valuation of the company. But if we're just talking about, the next few years, if we're just kind of constraining ourselves to a shorter time period, then assigning 19, 20%, 1/5 of the value of the company to Optimus doesn't seem crazy to me. It's still a significant valuation, right? If Optimus was a pure play robotics company, it would be the largest valued by far, right? If Tesla spun off that division, right, and it maintained 20% of the current Tesla value, it would be massive company in terms of valuation for a product that doesn't exist yet in the marketplace. So kudos to them for sticking their neck out with that, right? This is great. This is one of the first sort of analysts that's done that. There's been a few others, and it's a recognition here in the first three of these business segments, Robotaxi, Optimus, and full self-driving. This is the AI-powered part of Tesla coming through. So this analyst is no longer looking at this company as an auto company. So again, another step, another sign that we're moving forward in terms of the analyst community understanding what Tesla is, right? So that's great. And until we can see the details here, it's a little hard to quibble with the exact numbers. I'm a little surprised that energy is so low. But again, if we're constraining ourselves to the next few years, then yeah, it's going to take a while for energy to catch up to autos. And of course, there's no mention of other parts of the business that are also valuable. But still, let's give them credit for this approach. That's great. Now, there's a couple funny things here, right? The higher target reflects a lower cost of equity. Okay, fine. So as interest rates come down, the rate of return that investors demand in investing in companies comes down too, right? Because if the interest rates on bonds are lower, then the return on equity will also come down. That has the effect of juicing current prices, right? If your required rate of return comes down, that means you're willing to pay more for it now. So, and I guess he's sort of saying, well, that's reflected in the current stock price. But he's also adding here that, better Robotaxi progress. That's interesting. He must have had really low expectations for Robotaxi. And again, without further details, it's hard to know specifically what he's referring to here. And then the most puzzling thing is a higher valuation for Optimus to account for potential entrance into international markets.
Yeah,
Did you think for a second that Optimus wasn't going to be sold outside the United States?
apparently they did.
Yeah. Yeah.
Good call out, sir. I mean, okay, so like you said, some wins here, right? We have an analyst who's actually looking at some of the parts, but it still seems fishy that they take the 471 and they go, okay, well, let's break it down. And then they go, 19, because if you truly did, and I'm going to show them your actual analysis, if you truly did do a sum of the parts, discounted cash flow model to the present value, you're not going to have 90% to Optus. You're not going to have, it's going to be more like the table you put together. 80% is going to be Optimus. Okay, let's go through now your
Yeah.
deck.
And by the way, Herbert, just because they're doing a sum of the parts doesn't mean that it's a sum of the parts based on the discounted valuation of all the earnings into the future. It could just be a sum of the parts based on whatever valuation metric that they're using. Sum of the parts is good, right? That's one step. You're looking at all the different business units. Awesome. But then the question is, what's their valuation metric? Are they still using a PE multiple on autos and a PE multiple on energy and then summing all those parts together?
That's likely what they're doing. Because, these analysts are very reticent to try to go past a few years. Like you said in your intro earlier, they don't go past because they don't know 5 years.
There's nothing for them to be gained for them to gain by doing that. It's not going to help their bonus this year. Yeah.
Well, you're going to get a bonus, apparently. So let's take a look at your work because you do a ton of work. Thank you for doing that. So this is, again, we presented some of this 3 months ago. And did you want to make a quick comment of how accurate are these numbers, even though you did this analysis 3 months ago?
Yeah, because this is long-term in nature, one quarter isn't necessarily going to change a whole lot. And perhaps as we go through here, we'll have an opportunity just to kind of review things in terms of what we know now based on the third quarter results. But this is kind of, again, it's a long-term model. It's a broad brush. Nothing in here is a particular price target. We're trying to show ranges of values, and some of these ranges are large enough to drive a bus through, right? Or at least a robo-van, right? And so just trying to sort of show what matters for Tesla, what's driving the business, rather than any specific price target. Like, don't anchor on a single number here, please, because that's not really the purpose of this. We are going to show what we think, could be the present value of the company given various scenarios. But even there, what discount rate do you want to use? Are you expecting a 10% return, 12%, 14%, right? So all that matters too.
Okay. So what we're going to do is show the analysis you did, the research you did on Tesla's current valuation, what the stock price should be. First, we're going to look at if this company was just autos, energy, and service, here's what the stock price should be. Then we're going to add in Robotaxi, and then we're going to add in Optimus. So let's go through this now. I don't know if we should. Do you want to go through each of these again, or do you want to just go right to the actual
I think it's
price?
helpful just to review this again. It's, I think it's instructive just so people understand what the base of each of these models is, right? So just to anchor the green, the 2025 there, 1.7 million in that second column. And then we're making an assumption about how many EVs Tesla produces. So 2 million in 2026. That seems reasonable to me. Maybe a little high. We'll see. 3 million by 2027. Yeah, possible. It all kind of depends, I guess, on how many Cybercabs are able to be built and how quickly they ramp that up. So if I was being really conservative, I guess I could reduce these near-term numbers. But I'm capping it at 7.5 million in 2030, not increasing it from there. So maybe if we take out some of the near-term numbers and put them more in the back, I don't think it's going to materially change the model. But I just want to mention that, I could see people quibbling with this ramp here, and that's fine. Okay. And then we've got in the fourth column, the average selling price coming down over time from like 41,000 now down to 31,000. Okay. And then it calculates the auto revenue, and I've got net margins going up. Now, in this case, I've got margins going up from 10 to 20. And I guess in this way, I've kind of accounted for FSD. If FSD uptake is more, then that increases margin. So if you want to consider that I've taken into account FSD, then here it is. But I think some people also feel that the margin potential just on making EVs at this kind of scale should go up, right? So however you want to think about that, that's fine. And then we've got the profit column, and then I'm applying a PE ratio. So in this particular chart, I'm using PE ratios. When we actually do the discounted cash flow model, the PE ratios don't factor in. But just here, just so people can see what the value of the each business line is at different dates. So I'm applying a PE multiple to it. So feel free to apply your own. If you don't like my multiple here of 50 in 2025 on the auto business, right, which gets to a $350 billion valuation, let's say you think the auto business is worth half of that, fine. Change the PE multiple, put your own number in there, come up with your own valuation. Perfectly fine. And I've got the PE going from 50 down to 20 by 2035. And by then, it's a $930 billion business. So I've tried to design this in a way that viewers can take this information and make adjustments that they feel are warranted and come up with their own numbers without redoing all the calculations. If you think Tesla's only going to produce, 4 million vehicles in 2035, then cut these numbers in half, roughly. Right. So you can kind of make some quick and dirty adjustments if you want to.
Now, just to clarify with you, when you say EVs produced, that includes Robotaxi, right? So autonomous cars,
Yes.
like cyber cabs. Yeah.
Correct.
And so when I look at this, it looks very conservative to me. I mean, so yes, we did have a bump. We had a flat growth the last 3 years. So we're at 1,700, it's 1.7 million this year. Great. Yep. And then if I look at Elon's objective and milestones, he needs to get to 20 million. So there's 8 million by the end of this year out there. And so then he needs 12 million.
Closer to 9, I think, Herbert.
What's that?
Closer to 9. We're over 8.5 million now, I think.
So 9 million by the end of this year. Yep. And then he needs about 11 million to hit his 20 million target. 2 plus 3 is 5 plus 10. So by the end of 2030, like that makes sense to me. That would be something he would strive for, maybe. But then if you think about Robotaxi, and then if you think about that every car sold now has incredible FSD, incredible, like this car really, like you and I are driving it today. And if everybody knew how good it is now, garage to parking, parking to garage, it's unbelievable. I think car sales is going to skyrocket for Tesla. So I'm okay. I think this is fair. So now you got energy storage. So that is your auto business. That's how you come up with maybe a 930 by 2035, 930 billion. And then energy?
Energy, similar approach. And so we've got the storage deployed. So I've got 50 gigawatt hours in 2025. Yeah, they just did 12 and a half in this last quarter. So basically just annualize that at 50. And then I've got it doubling next year and so on. So I've got a pretty aggressive ramp here. The demand, the need for storage is out there, right? Tesla has a new factory coming on in just outside of Houston. It's going to take their capacity up to like maybe 150 gigawatt hours by sometime next year. So I've got them crossing that sometime in 2027, right? So I'm expecting them to continue to build capacity. But by 2035, I've got them building or deploying 3 terawatt hours of energy storage. Massive ramp, okay? Now, offsetting that is the price per kilowatt hour that they get for storage. I've got that basically getting chopped by half over the next 10 years. Maybe that's not enough. Maybe it goes down by more. We'll have to see. I've got the profit margins, net margins, by the way. A lot of times we talk about profit margins and we're referring to gross margins. These are net. This is after all costs, taxes, everything, of 15%. And I don't have that going up here. So maybe it's more, maybe it's less. We'll have to see. And then you can see applying the different PE multiples. So in 2025, I've got a PE of 55 on this business. Gets you at about $110 billion valuation on energy. And by 2035, PE just 20 and a $1.35, $1.4 trillion valuation on energy. So actually a higher valuation here than on the auto business using the same PE multiple.
Yeah. Again, I look at this and I think it's fair from my perspective because if they build out one new megapack factory each year, that's why it doubles. We know it's going to double next year. That 50 to 100 looks like, what? You think it's going to double? No, because they've built a new factory and that's going to now be scaled. And then they're going to build another factory, which is, the Giga Austin or Megapack factory in Houston is going to go online. And then if they build another factory, announce it by a couple of years from now and so forth. So I think this makes sense.
You get to some big numbers there, right? Like
these numbers get crazy at this point.
Is enormous. It looks.
But we know that Elon has ambitions to hit those huge numbers. So but this could be a little bit too much. Yeah.
But look at the number in 2021 of 4 gigawatt hours and then 7 the next year. So this year they could be 10x that just in 5 years, right? And I've got 10x again in another 5 years. So
and then a 3x. Yeah.
Right. It's certainly possible. Okay. It seems crazy when you put it on paper to look at it and say, well, really a 10x in 5 years? Well, yes.
And this is Elon's goal. And so maybe he's right, maybe he's wrong, but that's fair to Okay. Services another. Oh, that was an interesting one for this quarter.
Yeah, I was impressed with that. That surprised me from a profitability standpoint. And I think that's actually very encouraging because that business unit now, which has as much revenue as energy does today, is actually contributing meaningfully to the company's profits. And you can see in this model, I've got pretty low expectations, frankly. The revenue only going from 14 billion this year to 75 billion by 2035, right? And the margins, I've got the margins going up, net margins going from 3% to 10. But basically, this business by 2035 is maybe $100 billion business.
Okay.
This is insurance, supercharging, used car sales, maintenance, service.
By the
that
way,
kind of stuff.
we didn't mention it, but FSD is apparently going to show up here.
Well, they said Robotaxi right now isn't here. I think ultimately
FSD.
the Robotaxi
Services. FSD will show up in services.
Yeah. And if that's the case, then I guess that explains why the margin's going up.
And this is where that's where if you want to add it, right? Isn't it? This is where that's going to show up, not not a separate line item, not in Robotaxi, not in auto.
And I would imagine, though, over time, if FSD becomes a significant business, significant number, that it gets its own business line potentially.
And or as you and I have been talking about, the cars might move to a leasing monthly fee that it's all bundled.
Mm-hmm.
Okay, so
add those three businesses together, and I've got that probability column there in yellow at the top, or line at the top, and I've just got 100%. So again, you can take whatever probability you want. If you think my numbers, there's some issue, you can say, well, okay, I'll take 80% probability, multiply everything by 0.8, and there's the number. But basically, you can see there, if we just take autos, energy, and services and other, in 2035, we get a valuation of the business at about $2.5 trillion and a stock price of about $544. Okay, just for those businesses. Now you can see that
that's
the stock
future
price,
share price. So what would be the
correct?
We're going to get to the next table that shows us the present share price of these three.
Well, that's a different analysis, but we're going to talk about that from a company-wide perspective. And you can see though that because the PE multiple is coming down, right? I've got a PE of 40 in 2030, and then I go down to 20 by 2035. I'm bringing this PE multiple down pretty aggressively. The share price in 2030 just on these three businesses is actually closer to 700. But because the PE is coming down faster than these businesses are growing, the valuation is actually lower in 2035, right? So it's a little weird that way, but again, I think still instructive that these three business units are pretty valuable, but they're not going to be the drivers of future valuation gains for this company, in my opinion.
Okay,
they're important. Yeah.
So this is how, if you just look at those three businesses, what should Tesla's price target be today? If you don't believe the Robotaxi exists and robots exist, and you just say, hey, we are just an energy company, an auto company, and services, what is the price target today? Oh, you're saying that it could be just $132 or it could be $234, which is half of what it is today.
Yeah. So there's a few things to point out here that's important, right? First of all, I'm assuming a 60-year life of the company. I'm modeling out year by year, business unit by business unit for the next 10 years. And then I'm projecting forward at some growth rate. That's the orange or yellow line there in the middle. And I'm using growth rates that range from 0 to 10%. So pick your poison there. Which growth rate do you want to look at, right? When you're doing long-term modeling, it's dangerous to use too high of a growth rate because it's really hard for companies to compound at 10% for 60 years, right? Let's be honest about that, right? So maybe you settle on 2.5 or 5, okay? So let's just focus on 5. Let's focus on the middle column just to make things easy. Okay. I am also assuming dilution. I'm assuming a 3% growth rate in the number of shares outstanding. We have to pay the employees. They get paid in cash, but also stock options. And we have to pay Elon. So 3% dilution, I think, is a reasonable number. And then we have to discount all these earnings back to the present. So if we're modeling out 60 years worth, we've got to discount them all. So when you do that, the earnings in year 40 through 60 are almost meaningless. It's really just the next 20 years really impact this model. So even though I've got 60, a lot of people say, "Oh, really? 60 years? You're sticking your neck out and you're going to model 60 years?" Well, those last 40 years don't really matter that much. It's the next 10, maybe the 10 after that, because when you discount something so far out back to the present at 12%, it brings that to such a small number. Okay. Now the model does have buybacks built in, and in this particular model, I'm assuming no buybacks. So that's only upside if they buy back stock and don't just sit on cash on the balance sheet earning next to nothing. But I do have a return on their cash on the balance sheet of 3%. So you can imagine investors would rather have the cash than have it sit at the company earning 3%.
Like a dividend? Is that what that is?
Dividend or a buyback would be preferable because buybacks are more tax efficient for investors. So again, that makes these numbers more conservative. It's an important point to point out. No buybacks. And virtually every company in existence today that's successful has a buyback program. NVIDIA buys back a ton of stock. Microsoft, all those companies buy back a ton of shares, okay, when they have massive excess free cash flow. Tesla will probably do the same. There are some other alternatives we won't get into today, but in this model, I'm assuming no buybacks. The cash just accumulates on the balance sheet, only earning 3%. So that actually becomes a bit of a drag on the company. So yeah, you get to a present value of about $160 some a share today on that, just with the three existing businesses. So not bad, but if that's all there was, investors would not be paying as much as they do today for Tesla, right? It wouldn't make sense. I don't know that I could torture this model to get to a present value of today's stock price. I think it would be really hard.
Yep, that's fair. But I mean, $162, if we choose the middle one here, $162, that's what auto, services, and energy should be. That's about a third, right? $162 of what it is today. I think that's fair.
Roughly.
So 2/3 of the price today is everything else that's not part of this. And we know that Robotaxi exists, so there's got to be something there. And then you have to kind of like guess whether or not you want to include Optimus or not yet.
Yep.
That's fair. Okay. So that's where it is. Now let's see if we do add Robotaxi, what does the valuation look like? You want to share this?
So the Robotaxi model is driven off the auto model. We need production, right? So now we're taking the EV production numbers and turning them to EVs delivered. So basically saying one and the same. Every car that's made is sold. Now, they could be sold externally, right? You and I could buy Robotaxis, but initially they're going to be company owned, right? So we have to make some assumption then about how big is the autonomous fleet. And so in 2025, I've got a fleet of 100 vehicles. And I've got that ramping to 1,000 in 2026. And I hope that is conservative. I've got it ramping to 2027 to 100,000, right? And then 1 million. And then from there, it goes up 3 million, 10 million by 2030. And by 2035, we're about 21 million. So the slow ramp here is a reflection of, we've got some regulatory things to overcome. I think FSD is safe enough to roll out as a robotaxi service in the many, many thousands of vehicles. But maybe we've got some regulatory hurdles to cross first. And that might take a year or two, maybe sometime in 2027. And then we've got the estimate for the amount of profit per vehicle per day. I think this is extremely conservative. But I've got it starting at $90 profit per day, going down to $54 by 2035. This is completely forgetting that we've got, once you have a robotaxi network up and running, it becomes a platform for other services. So it's actually likely that the net profit per vehicle per day goes up, not down. Yeah. Ultimately, it goes down because perhaps the cost per mile goes way down, like, 25 cents or something. So I think, again, given these conservative numbers, you can see the net profit growth. You start to notice it in 2027, $3 billion. And then by 2035, you're, 300, 400 billion in profit. And I'm applying a PE ratio to that of 50, which is high, but a business that's profitable and it has a lot of growth still ahead of it at this point, I think would trade at a pretty high PE. And that gets you to a, 20 trillion plus valuation, both in 2030 and also out to 2035. The reason that the valuation doesn't really go up after 2030 is because the PE multiple goes from 100 to 50. I'm really dropping that down. But if Tesla has 21 million robotaxis in the world, they probably get to 100 million at some point. So that's why the PE multiple is still pretty high.
I agree with that.
Right? If it works for 21 million, it's probably going to work for 100 million. So you can see, obviously, this is a significant value driver for the company if this business is successful. Just the scale of this is immense.
I think you're referring to net profit per vehicle per day. This just does the robotaxi, $2 maybe to 25 cents at some point per mile. Mm-hmm. But I agree with you. There's so much more that they can charge people at this point. Just like Netflix, where you have access to a Tesla movie premium. The big one, I think, is, I don't know if people realize this, but today in your Tesla, when you're going to the Tesla diner, the Tesla-owned diner, on your way there, the screen changes as you get close, and it actually will have the menu. You can order through the car, And it actually reminds you, apparently, that when you get closer, that you want to order it now because by the time you get there, it'll be delivered to you hot, you know?
Mm.
Anyway, so you can imagine that McDonald's and Starbucks and everyone else will partner with Tesla. And as it gets into the Starbucks, you've already pre-ordered it using Tesla's system, they get a cut. Tesla gets a cut. I mean, there's going to be something like this.
There's all kinds of cool things. Yeah, think about not having to wait at a drive-through line to place your order. You just show up and it's there. Yeah, no, that's great. And of course, they know exactly how long it's going to take your vehicle to get there, so they can time it perfectly for you.
Exactly.
Yeah. So we put all these 4 business units together, right? And by 2035, Robotaxi accounts for about 77%, call it 80% of Tesla's value. The very last number in that column there, yeah. So it's 413 billion in valuation. Sorry, this is that's showing the profit in that column. And total profit of the company is about $500 billion in 2035. Okay, and implying a total company value, the PE ratio there of 45, you get to about $24 trillion valuation, which, by the way, is about the same valuation in 2030. And again, the reason that the valuation stays about the same is I've got the PE ratio coming down, and that gets you to a stock price of $5,000 to $6,000 a share at different points in time. So, tell us where we got our robotaxi numbers wrong, right? Like, make
Well,
this
let me ask you. You put 100%, so you can interpret that in two ways. I think one is that there's a 100% probability that Tesla will have a robotaxi business and it'll roll out this way. Yep. The other thing, some people say, well, they're not going to have 100% of the market share. They're going to be like a commodity, and they'll have 30, 40, 50% of the market share, and then there'll be lots of other competitors. Is this number still hold up? If there are a bunch of competitors, that you still expect this many robotaxis out there and this much profit?
Well, if you felt that, I suppose you could cut this in half and then use those numbers. But the question is, I'd go back to the input sheet and I would say, okay, in a world where there's robotaxi competition, can Tesla still have a fleet this size?
Yeah, that's
in
what I'm asking.
2035, can they have 21 million vehicles if there's 1.5 billion vehicles in the world? Doesn't seem crazy to me.
Your answer is yes. So even if there's a bunch of other competitors that is equal to what your numbers say that of how many robotaxis are out there, you still think that Tesla's robotaxi will still hit those numbers that you forecasted.
Yeah. And I would also say too, like, where are these other companies that are doing this work?
They may not be here this year, but they might show up in 3 to 5 years.
Sure. Yeah. Well, maybe. I mean, how many years has Tesla been working on FSD? All right. It's going to take a competitor a long time. And by then, Tesla has, so much of the market. It's going to be very hard for anybody else to eat into their market at that point.
Economies of scale, lowest price, greatest value. By every metric, they're going to be so much better than any competitor. More cars on the road, lowest priced, more movies, more connection to things, and so that's why would you choose the other? But
it's funny because with the EV business, it's like this mantra: the competition's coming, the competition's coming. Well, okay, where is it? The competition did come, but they didn't make EVs profitably. So the question for the competition is, how much money do you want to lose trying to get a piece of this market? And if Tesla gets to the scale where they can drive down the cost and drive down the price of the service, any competition is going to lose so much money trying to catch up to them. It just becomes impossible.
I mean, just back on the EVs as well. I mean, imagine if you got FSD and you have the ability to make money with your car. Tesla could theoretically just lower its price of the actual car, how much you want to buy the car. And then at that point, what happens to the competition, right? Because you can be half the cost of a competition for an incredible car. Yeah. Because Tesla knows they're going to make the money up on robotaxi services in perpetuity for the next 10 years, for the next 5 years, the car exists.
It's funny, Herbert, because, in this whole thing about BYD versus Tesla, right? And BYD making more EVs than Tesla does. Well, thanks to AJ, we know that BYD has lost $10 billion this year. So is that really successful? Okay, they've outsold Tesla if you look at just EVs. Fine. But is that sustainable? Is that success? I don't think so. I think they're in a world of hurt. So any victory there in terms of outselling Tesla is temporary. And I think it would be even more difficult for a company to compete with Tesla in the robotaxi world. There's so many factors here. Not only do you have to make EVs at scale, which no other company has been able to do yet and make money, you also have to develop the FSD software. And Tesla's not stopping, by the way. Like, it's not like they roll out robotaxi and FSD is complete. They're going to keep improving that software. So it's a moving target. I think it's going to be next to impossible for anybody to catch them at this point.
I agreed. All right. So here would be the present value calculation. If you include Robotaxi. So you don't include Optimus, but you included Robotaxi. You've looked out to 2035. You've discounted the cash flow that you've calculated. You can choose which angle. If we look at the middle part, you're saying today, if you agree with the analysis you've done, the stock price today should be closer to $686.
Yeah. Now, there's one additional factor here. We did add a buyback rate of 10% of free cash flow here, because with Robotaxi, the free cash flow starts piling up. Like they're going to have to build, banks to hold all the cash. Right. So I've got 10% of the free cash being used to buy back stock, which the cash is still going to pile up even at that. Like that's just a drop in the bucket. But that's one difference in this screen versus the previous one. And here you can see even if you assume a 0% long-term earnings growth rate after 10 years, you still get a $550 stock, right? If you assume a 2.5% growth rate at 600 and a 5% growth rate, it's close to 700. So you can see it's not that sensitive to long-term growth in this model.
That's present value.
Present value.
If you look at this, if you do think that Robotaxi will go out in the way that you've modeled it out, at some point the stock price will be 1,700, 3,000, 6,000 kind of levels.
Yeah.
Just
right.
Robotaxi alone.
That's right. Yeah.
Wow.
Now the two right columns of the 7.5% and 10%, yeah, it might be a little aggressive, but again, in 2035, I've modeled 21 million Robotaxis. I think if they get to that point, they're well on their way to 100 million. So
yeah, and I think you've done the modeling too. That it's not for the audience. Don't think Robotaxi means ride hail. That it means we're replacing Uber and Lyft. No. At some point, this becomes replacing all transportation. At some point, people will stop buying new cars, and instead buy the Teslas, or just use Tesla's Robotaxis, and then just completely replace transportation. All these other transportation models where they're spending money on, they don't need to. Including trains, including buses.
I'll never give up. Yeah. There's a lot of people that say, I'll never give up my vehicle. I love to drive, et cetera, et cetera. Mm-hmm. Well, that's really the wrong way to think about it. What happens if I came to you and said, Herbert, I can save you $5,000 to $10,000 a year in your transportation costs? Your answer probably is, okay, I'm interested. Right? Most people would choose to save that kind of money, right? The average American certainly would. There are some people, certainly, wealthy people, doesn't matter. They can buy whatever they want anyway. So if they want a personal vehicle, they'll get a personal vehicle, but they're still going to use Robotaxi at times. It's still going to be the most convenient option for them.
Well, I mean, think about it. What do the rich people do all the time? They have a chauffeur. Yeah. So, they get to the point where they want to be chauffeured because, hey, first of all, there's time is incredible, right? Time is money. They're out there doing business. They're they so that when they get to the office, they can really be good energy. They outsource the driving, and then they buy their sports car that they ride on the weekends to love this. So that's might want to be what happens.
Yep.
All right. So this is very telling. You are at 686. If you were an analyst and you were modeling it out today, what would your price target be?
Well, let's keep going, shall we?
Oh my God! So I was going to give you the opportunity to stop here.
No.
You all done because so let's just are we here? Yes. So you're giving a 33% probability of Robotaxi, not 100%.
This is the next scenario. So if we looked at a scenario here where it's 1/3 of what I projected.
Okay, gotcha.
Just to see what that would be, and if you go to the next page, it calculates the present value of that at about 340.
So that's not a lot.
Which I think at the time was about where the stock was when we did the show.
Okay.
Right. So I was just trying to say, okay, what's baked into the market price? Mm-hmm. About 1/3 of the numbers that I was showing was baked in at that time.
Gotcha.
Yeah, but things changed a little bit since then. The stock price has gone up quite a bit since when we did this show last.
Well, the other thing that changed was that they rolled out Robotaxi. It's like alive. It's in big, so it's actually real.
That's right.
So.
Yep.
Okay. So now let's add, now you're adding semi and Robo-Trucking.
Yeah, let's not forget this one because I think it is significant, and that impacts the present value calculation by $150. Wow.
Significant.
Yeah, it's a big opportunity, and it's also very important in terms of the efficient flow of goods. It's important from a health perspective because semis today are producing most of the emissions on the roads. There's so many benefits to semi and autonomous trucking. We did a whole show on this. So yeah, it's meaningful.
Oh, it's for sure going to happen. I mean, they're already ramping up semi production. In fact, the thing is now complete. The facility, the manufacturing facility, 50,000 is what they're shooting for next year. But then it's going to go. And then if you can do taxi, you can do Robo-Trucking. And then this is even more lucrative because you don't just charge $2 per mile. You can make a lot more money.
And this, by
Okay.
the way, was getting to production of like 125,000 trucks a year by 2035. Not a big number at all.
Not a big number at all.
Yeah.
That's tiny.
Yeah.
All right. So that's semi Robotaxi. Now let's add Optimus and AutoBidder.
So in my mind, Optimus is a done deal in the sense it's a product that's going to happen. It's not solved in the sense that you can deploy these in factories and warehouses today and get a lot of value out of them, but it's coming and it's coming very quickly. We're seeing a lot of positive developments from the other robotics makers, but I'm also here to say that this isn't happening this year. It's not happening really much next year. Over the next 3 to 5 years, it's going to happen. So my ramp sort of reflects that.
Yes.
I've got 100 bots this year. Who cares? It's close to zero, right? You could put 10 in there. It doesn't really drive anything in this model. And in 2026, 500. And then in 2027, a legion, 5,000. And then by 2028, we're starting to ramp. Okay, so I think reasonable near-term expectations, and hopefully we get surprised on the upside here. But the challenge with this is that they have to build the whole supply chain from scratch and figure out how to do everything from scratch. None of this exists yet. But ultimately, we're talking about pretty massive numbers. And I've got humanoid bot production of like 75 million by 2035. It should be easier to build a bot versus a car. If you want to just divide by 10, that's kind of the number of vehicle equivalents. So maybe 750,000. So it wouldn't be that hard, in my opinion, for Tesla to go from today to 2035 and build a new vehicle and make 750,000 of that vehicle. Okay. And it may even be, half of that in terms of vehicle equivalents. Bots weigh less than cars. They should be easier to make ultimately than automobiles. There's less mass to move around in the factory. We may even have bots making bots, and that would be the dream, right? And I think ultimately we'll get there. The bot model is kind of like Robotaxi. They have a fleet. I've got a sort of bot, robots as a service model here in this model. So we're looking at the cumulative number of bots deployed. I've got the net profit per bot per day coming from $135 a day down to 42. Again, this I think is very conservative because as bots develop, as the AI improves, a bot becomes more valuable. It can no longer just move stuff around, which is maybe $5 an hour work. It can actually do things, manipulate things that become $20, $30, $40, $50 an hour work. So actually the profit per bot actually could go up over time. But in this model, I've got it going down. The good thing is I don't need it to go up because at scale, this is an insane business model. If you have 170 million of something in the world earning $42 a day, that's 2.6 trillion in profit. Okay. And apply a PE multiple to that in 2035 of 50, you're at 132 trillion in market value. Okay. Cut that in half. Fine. 65 trillion in market value. Cut that in half again. Fine. You're at a 12.5 PE on this business. You're still the 30-some trillion dollar market value on bots by 2035. It's the scale of this that's staggering. And that's why in that first chart we showed why we think bots is like 80% of the company's value, because it's a massive scale business. It's smart machines doing labor in the world that we need. This is going to be the biggest industry on the planet. I have no doubt about that.
Yeah. And these numbers align very well. Totally agree with you. Very slow here. Low, low, low. Much lower than people are expecting. But the million per 2030, that's what Elon has been saying now, 2029 to 2030, a million. Then he's also saying at some point he'll get to 1 billion bots. At some point he thinks it's 100 million. So at 75 million bots, that's not unheard of, or not compared to what he's saying that he's going to try to do. So again, this way out in the future, he could be totally just saying numbers like he has before. So, but still, like you did, even if you just cut it in half or a third of it, it's still big, big, big numbers. Massive. So now this is AutoBidder.
Yeah, it's driven off of the energy model, and then I'm assuming a certain number of those storage devices that are deployed would be AutoBidder controlled. Essentially, by 2035, about half of them. So that would be about 6.1 terawatts of storage that would be controlled, earning about $25 a day. PE multiple of 25, you get to a $1.4 trillion business on AutoBidder. Again, not to be ignored, right? Huge opportunity long term.
Just auto bidder alone, it's $1 trillion business.
Yeah.
That's another way to think of the company by 2035.
Yep.
So that's still 10 years away.
Yep.
Okay, so now you've added up all of these businesses, which is again, some of the parts, and you've got 100% Robotaxi, 25% semi, 100% Optimist though. That's interesting. 100% Robo-Trucking.
Yeah, good question. I guess I knocked my semi one down because I saw the Robo-Trucking becoming dominant. They're probably not going to
Yes.
really sell that many semis, so that's why I've knocked that down.
For sure.
But otherwise, 100% because I believe my numbers. And you can see here by 2035, about 3.3 trillion in profit, right? And I'm applying a P ratio there of 45, and that gets you to 150 trillion in valuation, which is insane, right?
It's insane.
30-some $1,000 stock price.
It's insane.
But,
I mean, obviously, NVIDIA's at 5 trillion right now. So this is crazy. But if you believe in bots, and I encourage you guys to go take a look at the bot analysis. We did a show where he shared exactly all this. And like you're saying, you aren't the only ones coming up with these crazy numbers. Other bot vendors have shown numbers like this. Other analysts have shown numbers like this. And it's just, no matter how you slice it, it becomes this thing where you're replacing all humans who work.
Yeah. And it's interesting. Look in the Optimus column at the very bottom, the white number, 78.5%. Mm-hmm. Again,
exactly
that coincides that Elon said 80% of the value of Tesla is Optimus, and I totally agree with him.
Yep, that's what your number showed at the time. So which another way that his own analysis might have done the same thing around this. Like and so far, by the way, I will say that your numbers forecasting of what you thought, how many, what price per margin, all these things turned out to be fairly close, right? You and I did a show one time, and then we talked to a bot vendor, and then it was like, they said, "Oh my God, you're exactly right." So okay, if you include the bot and everything, the true sum of the parts, all the way 2035. Discount the cash flow that you've calculated out there, you think it could be that the stock price today should be 3,000. But that's assuming 100% of what you've said is going to happen. $3,300 today. That's just obviously crazy talk. So,
well, maybe. I don't think it's so crazy, but that's fine. It's fine to have a margin of error. The question is, how big is this margin of error, or the margin of safety is another way to think about it. I think it's justifiable that the stock could trade at that level. The people that are PE adherents would freak out, and they'd be yelling bubble from the rooftops. So I think it's highly unlikely that we get there. We're going to have to actually see the revenue start to ramp before we really make any meaningful progress on numbers like this. But what I'm talking about here, what I'm showing is I think that the present value of the company is materially higher than where it's trading at today. So when we go back to that discussion about analyst price targets, I sort of laugh in the back of my mind because it's like, well, we know what's coming. They're going to have to keep chasing this for the next few years.
They'll chase. I think that's the point. The point is, if you are an investor today, you want to look at all your sources of information. The analysts are one, but they seem to be always chasing, and you explained why. They're really here to just look at what they think is going to happen in the next year. If you want to know what's actually possibly going to happen and look at the details, and you apply your own numbers, and you can take his numbers and move it around, goes, he's too optimistic here, that number's not right, they're not going to sell that many, they're not going to charge that high of a number by this year, it's going to be competitive. Plug it in. He made it easy. Easy, plug it in. Very interesting that these are the way to do it. But this is, I agree with you, some of the parts plus a discounted cash flow model, that's what you should be doing as a retail investor to really understand which businesses are valid. And then the fun part that I do is I follow the milestones of where the company's headed and the product and the business and see whether or not the company's progressing. Like I care a little bit less about what the stock price is going to be. It's just more about, they said that they're going to get into Optimus. Are they making any progress? Is it happening? Is it going to come out soon? Will it be sold? Will customers buy it? All that is what I look at, because if it does, stock price will follow. Like it will they can't help it because earnings will flow, cash will flow, all that, right?
Right.
So thank you so much, Cern. Always appreciate it. Interesting experiment that we did today.
Yeah,
So analysis
we have a front row seat into something I think that's very unique and very exciting.
can
It's going to
happen
be,
once in your lifetime.
yeah,
And guess what? We just watched autonomy happen in front of us, our lives.
we did.
Robotaxi here.
Yeah.
I was one of the very first sub 3,000 people that's actually was testing FSD 4 years ago. I was one of the very first to get into a Tesla Robotaxi in June. And then we're watching it become, we're going to watch this thing take over the world. And how every city will change, how society will change, how cost and pollution, all that things will be improved. So, and accidents and deaths. Thank you, Cern. Appreciate you.
Thank you,
Follow
Herbert.
Cern at BrilliantAdvice.net. Check him out there. Thanks, everybody. I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.